Our resurgent economy grew at over 6% pace in the first half of the year and was on track for over 5% growth for all of 2021. The current economic recovery, which started in May of 2020, has benefited from widespread vaccine availability and additional fiscal stimulus. We've had a hand up that has helped us through this period of unique economical challenges. In 2022, the economy may be ready for a handoff. Back to greater emphasis on the individual choices of households and businesses, how smoothly that handoff is executed may determine the course of the recovery. The US economy bounced back from its worst year since the Great Depression in 2020, with one of the best years of growth in nearly 40 years in 2021. A combination of record stimulus, healthy consumer and accommodative Fed, vaccinations, and reopening of businesses all contributed to the big year. In what amounted to the shortest recession in record history, only 2 months in March and April 2020, the economy came roaring back to produce what is currently expected to be over 5% GDP growth in 2021, more than making up for the 3.4% drop in GDP in 2020. Of course, there have been some hiccups along the way. You can't shut down a $20 trillion economy and then expect to get it going without warming it up first. Supply chain backlogs, material and labor shortages, and high prices held the economy back to varying degrees. The good news is demand is still very strong. And as the backlogs unwind, which could take several years in some cases, we expect the above trend economic growth and see low risk of a recession in 2022. With various measures of output matching or exceeding pre-pandemic levels, it's clear that last year's recession is in the rearview mirror and may go down as the shortest one in history, even shorter than the 6-month recessions from the early 1980s. As the US economy moves more to a mid-cycle, our 2022 forecast is 4 to 4.5% GDP growth in 2022. While slowdown from 2021 is still a very solid number, we still expect inflation to tame from 2021 levels a little above the 3%. We're currently at about 6%, with core inflation numbers lower, which is a step in the right direction, although it may still be an upward trajectory in the early part of the year. Globally, Europe and Japan were hit especially hard by the pandemic in 2021. But as COVID-19 cases potentially fall globally, those areas could be ripe for better economical growth in 2022. Meanwhile, when looking at emerging markets, they may disappoint as China could be constrained by the regulatory crackdowns. 2021 was the year nearly everything was in a shortage, and it all translated to added inflationary pressure. Record numbers of ships waiting at ports, the lack of materials, unfulfilled job openings, higher commodity prices, a lack of truck drivers, major backlogs, and supply chain disruptions all added to the large price increases seen essentially across the board in 2021. While we believe these pressures will steadily decrease over the next year and inflation will eventually settle back to that 2 to 2.5%, it likely will be a gradual process. Inflation remains near historic run rate after removing the most volatile pandemic influenced prices. The more stable measure of inflation has historically tended to pull broader readings of inflation towards it over time. Still, supply chain may take a year or two to be fully addressed, depending on the product and the scale of the problem. Despite challenges around supply chains, hiring, and prices, if demand is there, it should help drive continued improvement as businesses adapt to address these challenges. That's likely to leave us with a positive economic backdrop for at least 2022 and maybe much longer, despite the current inflation levels. Prospects for above average economical growth accompany earnings gains in 2022 point to another potentially good year for stock investors. While the pandemic is not completely behind us, and there are several other risks to watch, particularly inflation, stocks have historically done well in mid-cycle economies. We do believe that we have started or are already in the middle of an economic cycle with at least a few more years left. Historically, if this holds true, then we believe the chances of another good year for stocks is quite high. 5,000 would be a nice round number for investors to celebrate. The question is that when will that celebration take place? In 2022 or later? If we assume the S&P 500 earnings growth improves to around its long-term average of 8% or $235, well, the price to earnings ratio stays about where it is between 21 and 21.5. The S&P 500 could be fairly valued at 5,000 to 5,100 at the end of 2022. If interest rates stay lower for longer and support the price to earnings multiple expansion, stocks could potentially exceed this target by the end of the year. But if profits margins face more intense pressures than anticipated, possibly from wages, earnings may have been hard time growing at all in 2022. In a mid-cycle economy, recession fears do not typically cause stocks to fall in a given year, nor do stocks typically surge as investors celebrate emerging from the prior recession. Over the past 60 years, the S&P 500 index was up an average of 11.5% during the 30 mid-cycle years we identified, with gains in 80% of those years. As you can see, stocks rose during most of these mid-cycle years, with 1966 and 1977 being the only 2 years with double-digit losses. The Fed, which we expect to start raising interest rates in early 2023, can help us gauge the cycle because the central bank typically begins to raise rates when the economy is exhibiting mid-cycle characteristics. That also characterizes 2022 as likely mid-cycle year. Historically, the stocks have done well during the 12 months leading up to the Fed's initial rate hikes, with gains in each of the past 9 instances of an average gain of 15%. We expect stocks to follow this mid-cycle pattern, potentially deliver double-digit gains in 2022 as the economy continues to expand at a solid pace. An expanding economy is a great start, but stocks fundamentally derive their value from earnings. Stable profit margins and increasing share buybacks make double-digit earnings growth for the S&P 500 a possibility in 2022. However, COVID-19 related supply chain issues and materials and labor shortages could lead to higher costs next year, potentially weighing on profit margins. As a result, we are forecasting slightly below average S&P 500 growth of 6% in 2022 or $218 in S&P 500 earnings per share. Higher corporate taxes could also potentially eat into some of those earnings in the gains this year. For 2022, near-term inflation expectations above historical trends and improving growth expectations once the Delta and Omicron variant recedes are reasons why we believe interest rates could move moderately higher from current levels. In 2022, we expect the 10-year Treasury yield to end the year between 1.75 and 2%. However, an aging global demographic that needs income, high global debt levels, and ongoing bull market in equities, which potentially means more frequent rebalancing into fixed income may keep interest rates from going much higher in 2022. While we don't expect interest rates to move much higher this year, because starting yields for core fixed income are still pretty low by historical standards, returns are likely to be flat to low single digits in 2022. Not a great year, but we should see improvement over the negative fixed income returns we've seen in 2021. With long-term interest rates close to what we think will be cycle highs, it's important to visit the case for fixed income within broader asset allocation. Core bonds have historically provided capital preservation, diversification, liquidity to portfolios, which we think are important to portfolio construction objectives and help clients remain committed to their investment goals. With the economy likely transitioning to a mid-cycle, the need for high-quality bonds increases in our view. Moreover, the need to offset potential equity market volatility remains an important role of core fixed income. Bonds, particularly core bonds, have been less volatile than stocks and have historically provided ballast to portfolios during equity market drawdowns, which, as we know, are normal occurrences from time to time. The maximum drawdowns for bonds in any given month has been dramatically less severe than stocks. While the worst drawdown in a month for equities was 28%, the worst for bonds during a month was down 6%. And those losses were quickly reversed. So when combined with equities, bonds help reduce the volatility of a portfolio, which makes for a smoother investment experience. What's next for credit? As the economy transitions into a mid-cycle, credit investors need to be more cognizant of downside risk. While the economy should still be conducive to credit risk and corporate balance sheet generally remain in good shape, credit spreads are among the lowest they've been in years, which means compensation for added risk of corporations is low. Both investment-grade corporate credit spreads and high-yield credit spreads are in the bottom 5% compared to history, which means valuations have been cheaper 95% of the time over the past 20 years. Corporate credit markets, both investment-grade and high-yield, are currently priced near perfection, so any unforeseen event, either related to the economy or at the corporate level, could negatively impact the credit market. We remain neutral on investment-grade corporate credit, but we think equities continue to offer better upside return potential than high-yield bonds, where we remain underweight. For income-oriented investors willing to take more risk, we think bank loans still make sense where appropriate. Federal, state, and local governments, usually better suited for the role of timekeepers or race officials, have run a strong leg for the economy over the last 2 years. No one would find this level of government involvement ideal under anything close to a normal circumstance, even if it was necessary to some degree in the face of the pandemic. But the private economy was by no means on the sidelines while this was happening. While some service-based industries were devastated by the pandemic, businesses on the whole innovative, adaptive, and evolved. They have positioned themselves well to take the handoff and run the next leg. And our market views reflect that. We are watchful of the risks associated with government passing the baton in 2022, but we believe that ultimately the economy will be healthier while still managing to create opportunities for investors.